Welcome back to On the Money with Secure Money Weekly Report. I'm Rob Hertig, here with my good friend Brian Quaranta.
Rob, how are you today?
Man, I'm awesome.
Good.
I'm awesome. I know you are too.
Yeah,
I know
very
you are
busy
too.
though. Very busy though.
Yeah, people are worried right now.
Yeah, they're very worried, and they have every right to be. They
Yeah.
have every right to be, because you're talking about 40 plus years worth of work at risk in the market right now. I've met a lot of people that are just losing a lot of money right now. They're terrified. You talk to other people and they don't even want to face the reality of what might be happening to their 401ks or their retirement accounts. But it's not a time to stick your head in the sand. This is not a time to kick the can down the road.
When you have 14 years of positive reinforcement, right?
Yep.
We're winning, we're winning, we're winning. And even in 2020,
Yep.
we had some of the most volatile days the market's ever seen. 2,000 point swings one way or the
Yeah.
other. And we still finished 2020 up.
Right.
Right? All
Yeah.
through COVID.
All through COVID, yeah, yeah. And it was the injection of all the capital
Yeah.
into the market too. I mean, come on, we had kids that were investing their money that they were getting for college through their Robinhood apps or their TD Ameritrade apps, and they were making a ton of money, right?
Crazy.
I mean, how many people have we heard, millionaires? How many stories I hear from our clients about their grandson or their granddaughter making $1 million in cryptocurrency?
Right.
You know, it was just, when I saw that happening, I knew we were at the peak. Because when you hear things being that easy, you know the run's about to be
Right,
over.
like Henry Ford when he said
Yeah.
he knew how to get out of the market because a shoe shiner gave him investment advice.
Yeah,
right.
that's
like you know the market's saturated when the guy shining your shoes.
Yeah, is giving you investment advice.
You're,
That's
you're
right.
in a bad spot.
Yeah.
You know it's tough. You know, both money managers and consumers get this confidence as years go by and they're winning,
Mm-hmm.
and it's almost like they forgot that you can lose at some point.
That's
and
right.
We get guys that are on the TV with commercials saying, you know, certain things that we used in the past to make sure we live great retirements,
Yep.
that they're bad and we hate them and
Yeah.
we don't have them.
Yeah.
I'll bet you the people that are with that guy right now wish they had an annuity.
Yeah, well, annuities are a very important part of planning. I mean, for some cases, you know,
Yeah.
not all cases. You know, everybody's situation is different, but you know, you got to remember that the losses will hurt you more than the gains will help you.
Right.
Right. Let me say that again. The losses will hurt you more than the gains will help you. So, and the reason I say that is because when you retire, it's not about getting 100% growth of the market. It's about protecting your downside.
Right.
And most people don't hedge by protecting their downside. So, you know, market goes down, they lose 20%, 30%, 40%. We need accounts that if the market goes up, we can make a little bit of money, but
Right.
if the market goes down, we don't lose.
Right.
And the design of these annuity products today will allow us to do that, but they'll also do something else very important. They'll provide us with a guaranteed income stream, not only guaranteed for your life, but guaranteed for your spouse's
Right.
life. And any money in the account will go to your family members, or at any point in time you wanted to take that money out, you could take it out. Depending on when you take it out, you could pay some penalties. But at the end of the day, we have ways to protect money today and still get some growth in the market.
You're a fiduciary, the other advisors at your firm are as well. And by law, you have to do what's in the best interest of the client, right?
That's right.
You know, my problem with what happens, you know, in the media, there's always certain themes that start to get carried away, and there's always multiple versions of the story, right? We see it over and over again.
Yeah.
So this narrative that annuities are bad, well, there's 4 or 5 different kinds of annuities, right?
That's right.
And
Yeah.
what I've noticed is these people on TV that run these commercials, they are taking the worst parts of every different type of annuity and combining them like they're one organism, and they're not.
That's right. They lump it all in together.
Right.
It's not a fair analysis, right?
And I think there's bad annuities.
Oh, absolutely.
And I think there's good ones. I think there's ones that are appropriate for people and ones that aren't.
Yes, and you got to know, in the annuity market, you have to know what you're looking at in order to purchase the right one and get the right one that's going to solve the problems that you need it to solve.
Right. Some do accumulation, some do income for life that you can't outlive, that's guaranteed. Even if you outlive the money that's there, you have a payment coming in. So give me an example of where you would use like an accumulation vehicle.
Yeah. Well, look, so let's say you're getting ready to retire, right? And you know, you're retiring and the only amount of income that you're going to have on a guaranteed basis is your Social Security check, okay?
Right.
So let's suppose, and this is about 85% of the people retiring today, right? Let's say that you need an extra $20,000 a year in income, right? Well, you've got two choices. You could keep all your money at risk in the market, and you could pull that $20,000 a year out of your investment portfolio, okay?
Right.
And as long as the market cooperates, you got nothing to worry about.
Taxes don't go up, no inflation, no market drops.
No market drops, most importantly, right?
Yeah.
No market drops, most importantly. But if you're trying to get $20,000 of income out from a stock portfolio and you pull that out and the market's going down like it has been, now you're compounding those losses, and this is what we see where people will spiral and run out of money. And they're not running out of money in the first 10 years of retirement. They'll run out of money in like 15 to 20 years when they don't have the physical health to go back to work.
You need it the most.
When you need it the most.
When you're the most vulnerable.
When you're the most vulnerable. So what the annuity does is by carving that money off, by carving a portion of your money off and placing it into that guaranteed account, we can provide that income stream of $20,000 a year.
Yeah.
And in even some annuities, that $20,000 a year would increase every year.
Yeah.
Okay, so we can even get increasing income. Now you tell me, would you rather have an account that could run out of money, or would you rather have an account that wouldn't run out of money?
Well, people over the last 14 years, they fell so in love with that account balance.
Yes.
And they thought that was important. And I think what they're finding out is a paycheck is way more important than that great big account balance. We've convinced everybody to operate like we're all independently wealthy, right?
Yes.
Let's do it like the wealthy do. Well, you don't
Yeah.
have the money to do it like the wealthy do.
That's right.
Wake up.
That's right. I always say, would you rather have $1 million in your account, or would you rather have a guarantee of income of $50,000 coming in a year? I would rather have a guarantee of income of $50,000 coming in a year rather than $1 million sitting in my account that could go down and I could lose it.
Yeah.
You're right, Rob. That income is more important than the account balance itself. It's the monthly income that gives you peace of mind and security in retirement and really allows you to have the retirement that you always wanted. Because nobody wants to be worrying about the pandemonium on Wall Street when they're
Right.
retired. They want to be spending time with their kids and their grandkids, right? And their families and going on vacation. They don't want to worry about being on vacation on some cruise and the market just dropped 30%. And they're thinking to themselves, we probably shouldn't spend the money we're about to spend on this cruise because we're not going to have a whole lot left after the market takes it from us.
Yeah, you actually just made me think of something. So the prospects, the people you're meeting with that are coming in that are scared,
Yeah,
a lot of them have lost 20, 30, 40% in the market.
correct.
How much have your clients lost in index annuities?
Yeah, zero.
Zero.
Zero. You cannot lose money in those accounts. And even, the other good annuity is even something called a fixed annuity where you can get a guaranteed rate of return.
Kind of like an old CD, right?
Like an old CD
Yeah.
where you can get, 3.5%, 4% rate of return. We'll probably see those rates go up even more.
Oh, I'm watching it day by day. As the interest rates are going up, I'm seeing those yields on the back sides of those climb as well.
That's right, Rob. These indexed annuities are alternative asset classes that are not correlated to the stock market. That's the most important thing. They're built off an options portfolio that allows you to get this upside gains without the losses. But this is why our right track retirement system is so important, because I've built this out to cover all of these areas. And I want people to have this information. And folks, if you call in and schedule a time to come in, I'm going to walk you through our right track retirement system. We really have done a good job breaking this down so you have a simple, easy to understand plan that's going to provide you with income and peace of mind in retirement. We're going to show you a better approach than just rolling the dice and taking risk. If you've won the game, folks, there's no reason to keep playing it. Take advantage of the right track retirement analysis. All you got to do is call 1-888-382-1298. Again, that's 1-888-382-1298, or scan the QR code.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people will also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
Welcome to On the Money with Secure Money. I'm Rob Hertig, here with Brian Quaranta.
Rob, good to see you, as always.
Always good to see you. We always have a lot of fun here.
Yeah.
So let's talk about stuff that's important and timely, right?
Yep.
We try to do our best job of it.
We
right?
do.
You have something here called the hidden tax. I think most people most people know what we're talking about here.
Yeah, inflation.
Inflation, right? It's a tax that you did not sign up for. Nobody voted on it.
No.
Well, they probably did by printing money.
Yeah.
But
they call it the stealth tax.
Really?
Yeah, they call it the stealth tax. I mean, think about it. I mean, look at the numbers here. I mean, first off, inflation's up 8.9%, as of this show here. Cost of flights up 33%, gas 40%. I mean, I've got, people watching the show here, and I don't know about your Facebook feed, but I'll see a lot of friends taking pictures of the gas pump now because they're shocked.
Right.
I had a friend just post a picture that $118 to fill his truck.
Yeah.
Right. But gas up 40%, car rentals up 8.5%. Used cars up 35%, energy up 32%. I mean, think about what's happening here to people. I mean, the average household could spend between $3,500 and $5,000 more buying this stuff.
Right. You know what's interesting though, Brian? Everything you listed there, it's either a necessity that you have to have.
They're consumer staples.
Right.
Yeah.
Or it's bucket list stuff, the stuff that you work so hard for your entire life and the stuff you dream about doing in retirement.
Yep.
And just watching this, I care about this stuff. I love what I do and I care about this stuff. And every day you see, the market's volatile, you see costs going up, and really what that means to people in the audience is you see retirement dreams being eroded in front of our very eyes, and people don't even know it yet.
Yeah.
Their heads are still in the sand.
They are, and they need to wake up because this is not an easy time right now, and this is not the time to keep your head in the sand and kick the can down the road and procrastinate, because if you don't make adjustments right now and you don't evaluate where you're at and what type of positions you're in, or understand the risk level that you're taking, or how much more your portfolio could potentially go down if the market continues to drop, or how this inflation increase is going to impact your spending. Right. I mean, most people, what we find fundamentally when we plan, I've been planning for over 20 years, is they don't have a plan.
Right. How
they don't
terrifying
have a
is
plan.
that? So how would somebody know if they don't have a plan, if they can't dictate exactly what their investments do? You don't have to know how they work, but if they can't tell you when they come in what everything does, would you say that person has a plan?
No. Most people don't know how to get their money to start working for them. See, we all saved and accumulated this money so that eventually when you retire, it actually started working for you.
Yeah.
And 85 to 90% of those people are going to need it to work for them, because most people are retiring without pensions. So when you don't have a pension and the only guaranteed source of income you're going to have is Social Security, most people are going to rely on those retirement savings to generate additional income.
So they're just waiting on their financial advisor to save them. If he's
Well,
not
the
calling
financial
you,
advisor, you know what they tell them, Rob? They tell them just pull the money out of the account. So they keep all their money in one bucket, right? And it's all in the market, and they hope and pray that the market's going to continue to cooperate. And when they call their advisor and they say, I'm really worried, we're continuing to take money out of this, and the advisor says, don't worry about it, everything's going to be fine, keep doing it. But Rob, I meet people every single year that are running out of money. I meet these folks, and I'll tell you, the worst day of retirement is not the day you run out. The worst day of retirement is the day you figure out you're going to run out of money and there's nothing you can do to stop it.
It's got to be heartbreaking.
It's heartbreaking for people.
You told me a stat between segments here, and it was, I think, with a 6% inflation rate, your income need doubles every 12 years.
Yeah, think
so
about that.
So you think about how long people are living in retirement now.
Yeah.
And think about if you're on a fixed income, right? If your income need right now is $50,000 a year, do you have enough money to last you when that becomes $100,000 a year that you're having to withdraw from your accounts?
That's right.
Talk about that.
Yeah. Well, when we have inflation, right, things get more and more expensive. And normally we have an inflation rate that's reasonable, right? We're seeing accelerated inflation. We might even be seeing stagflation, where we've got high interest rates, right, high costs, but low growth. Right, so that means portfolios are not even going to keep up with what they need. So how are people going to, when they see their expenses increase, how are they going to offset those expenses? They're going to have to make major cuts. They may have to reduce. They may have to sell their homes, go into a lesser mortgage, or go into an apartment, or
move in with family,
or move into with family, sell a car and only have one car. I mean, there's going to be sacrifices that people need to make, and unfortunately, they're not getting the advice on how to mitigate these risks as much as they can.
We always talk about providing solutions for people that they can do on their own.
Yeah.
I think the day of the do-it-yourselfer, you need to not be a do-it-yourselfer right now.
Yeah.
It's too hard.
Well, look, if you're a do-it-yourselfer and you've got time for your portfolio to recover, that's one thing. But if you're a do-it-yourselfer and you're planning on actually being the one that actually generates the income for your retirement, and you've been following some stock journal or some talking head on TV to get stock advice, you might want to think again, because that's okay if that's money that you can roll the dice with, but that's not money that you're going to be able to live off of retirement, because you're going to need a lot of things to go right in order for it to work. And a lot of people thought for the last 12, 14 years that everything was going right. How many people did we know in big tech companies that were making money left over, big time money? they're not singing the same tune anymore.
That's right. You're absolutely right. Thinking, talking about do-it-yourselfers, I like to look at houses.
Yeah.
And you can tell when somebody had flipped a house and is a do-it-yourselfer.
Yeah.
It's not the same quality of work.
That's right.
You can tell when somebody's not a professional. You
Yeah.
probably can tell when somebody's a do-it-yourselfer and they bring their portfolio in.
Yeah, yeah, and the other thing too is that not all advisors are created equal, Rob.
Right.
Not all advisors have the extensive training and planning strategies that we do at Secure Money Advisors. I might be a little bit biased, right? But I see the work that's out there, but it's no different than contractors, right? I mean, there's
Right.
good contractors, bad contractors. You go into a kitchen, this guy does this type of work, this guy does this type of work.
Doctors
are the same way.
Right. There's good ones, there's bad ones, attorneys.
That's
you
right.
just have to find the one that's right for you.
And I will say this, what I find is that a lot of people have a hard time making a change because they're too worried about the relationship.
I would say that the way that the quality of life and how we experience retirement is way more important than any relationship with any financial advisor.
That's right. I mean, that should be a business relationship with the advisor. If the advisor is not getting that job done, that advisor should be fired, period, bottom line.
Right. You'll fire your house cleaner, the guy that mows your yard, for doing something wrong.
Yeah, if the line's crooked or he
Right.
misses a few spots of the yard.
And that's not even that important, right? It's not a big deal.
That's right.
This is
Yeah.
the most vitally important. It's the hardest relationship to break up.
Yeah. Well, a lot of people are intimidated by having those conversations. They're intimidated by it. And I'll tell you, people don't realize that there's only 4 things that their money can do for them. It can either provide them with growth, it can provide them with safety, it can provide them with income, or it can be liquid. But it can't do all 4 at one
Right.
time. And too many people keep their money in one bucket, Rob.
Well, you always talk about your 3-bucket approach, right?
I do.
I know what it is. Explain to the audience what it is.
Well, they're actually going to get that 3-bucket approach. And folks, if you were to call today, the next 10 callers who call in, we are going to give you an opportunity to actually see our 3-bucket approach through our right track retirement analysis. I want to show you this because nobody is walking you through a strategy like this. I hear it from people all the time. I wish somebody would have shown me this 10 years ago, Brian. We would have been a lot better off. So for the next 10 callers who call in, we are going to give you a complimentary right track retirement review. All you have to do is call 1-888-382-1298 and scan the QR code. But I want you to not kick the can down the road. This is not a time to procrastinate. This economy is moving quick. You need solutions. You need somebody else looking at what you're doing to make sure that you're not going to put yourself in harm's way even more. Remember, losses will hurt you more than gains will help you right now. It really is all about protecting 30, 40 years worth of work and making sure you have what you have. So call that number today and schedule the right track retirement review. It's 1-888-382-1298 or scan the QR code.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people will also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
Welcome to On the Money with Secure Money. This is the weekly report. I'm Rob Herding. I'm here with my good friend Brian Quaranta. Brian, how are we doing?
Good, Rob. How are you? A lot of things going on in the market right now, huh?
There's a ton of stuff going on.
Ton of stuff, yes.
There's a pile of stuff. So we were talking before the show about how you've been in the business here for about 22 years, right?
Yeah, long time.
And it has been a long time. You've seen a lot of different stuff. And I was thinking about 22 years ago and where that put us, right?
Yeah. Yeah, well,
Where does that put us? Tell everybody when you got in the business. It was one of the
well,
most
right
difficult
right at
times
the end
to
of
get into the
'99.
business.
Yeah, right at the end of '99. I mean, it was tough, man. I mean, I got into the business and I saw people losing money right away because of the dot-com bust.
Yeah.
Right, and then that carried over into 2001, 2002, 2003. My first 3.5 years in the business, I didn't see anybody make any money.
Right. Financial advisors were running from the business at that point, right?
Oh, they were hiding under their desk.
Right. Nobody wanted to pick up the phone.
Nobody wanted to pick up the phone, but they had me picking up the phone because I was the new guy at the firm.
Right.
You know, and most of the other guys, you know, the guys who've been there for 25 years were hiding under their desk.
You got to be the bad guy.
Yeah, I remember taking a call from a guy that, you know, really changed my life and why I believe in what we do today at Secure Money Advisors. But he called the office and he said, hey, my name's Sam. I need to get out of the market today. I cannot lose any more money. Well, I didn't know what to tell the guy, so I went back to the managing partner and I said, we've got a guy on the phone that wants to place a trade, wants to get out of the market, and he said, Brian, let me tell you a little bit about the stock market. He says, you need to get back on the phone and let this gentleman know that it's just a paper loss, okay, and that he's in it for the long haul. Well, like a good employee, I went back and I said that to this individual. And he said to me something that changed my life. He said, Brian, I'm 75 years old. How much long haul do you think I've got left? And that's the scary part. When people lose money, they're losing money at the wrong time and they don't have the time to recover.
It's scary. It's terrifying.
It's terrifying.
And you know, a part of the problem with this is the standard definition of terms in our field isn't there.
Right.
If you're an attorney, if you're a doctor, you say one term, it means the same thing nationwide.
Yep.
You go to the retail shop on the corner, you know, the one that's in every town.
Yeah.
Their definition of risk is completely different than what yours is, I would assume.
Well, we quantify risk as if it can lose money, it's risky.
Right.
Where other people might say bonds are not risky.
Right.
I think bonds are risky, okay? Because we've seen, who would have ever thought that we would be looking at the 20-year Treasury bond, right? That's down almost, what, 20%? That's, you know, if you were giving advice for somebody to buy a 20-year Treasury bond, they would assume that that would be a safe place to put their money, and they've lost double-digit returns.
Well, the 60-40 portfolio was supposed to be bulletproof, right? Because the way that equities and fixed income work,
That's right.
they have an inverse relationship traditionally.
That's
Well,
right.
what's happening right now?
Well, look, we've got high inflation, right?
Yeah.
We've got volatility in the market, big volatility
Yeah.
again in the market. We've got every asset class being affected.
Yeah.
There's no place to hide.
You called this the financial perfect storm.
It is.
So what you dealt with in 99,
Yeah.
2000, 2001, 2002?
Yep.
Is that right?
Yeah,
That was tough, but it was just one risk, just the market dropping,
Just
right?
the market dropping,
Now you have
mostly-
4 things happening at the same time.
Yes, you've got high inflation, you've got volatility, you've got rising interest rates. I mean, everything's costing more. And the scary part about that for most people is most people in retirement or approaching retirement are going to be on a fixed income. So if it's costing them more to go to a grocery store, more to drive to go see their mom or their dad or their grandkids, that's a problem. A lot of these people don't have a whole lot of money left over at the end of the month anyway.
It's scary. Where do you cut from at that point? When you're on a fixed income, where do you cut? Because you have to have the necessities. You have to have the gas.
That's right.
You have to have the food. You got to eat.
Well, here's what's going to happen. It's going to force people to have to take withdrawals from their stock portfolios when the portfolios are going down. And that's a very dangerous thing to do. The biggest mistake people make when they're planning for retirement or going into retirement is they pull money out of accounts that are in the stock market. And so now you've got the market going down, they're losing money because the market's going down, and on top of it, they've got rising costs. So to offset that cost, they're going to take more money out of their portfolios.
Right.
This is something we call in our business called sequencing risk.
Right.
This can cause people to run out of money, and people will run out of money. I meet these people, Rob.
They were told for years that the systematic withdrawal approach, the 4% rule,
That's right,
would
yeah.
last them forever.
Right.
That 4% rule has gone down every year. It's, what is it now, 3.5%, 2%?
Yeah, well, the Wall Street Journal said that if you retire at the top of a bull market, right, that there's a high probability you could run out of money. Matter of fact, the article said that there's up to a 57% chance that your plan could fail if you retired at the top of a bull market. Why? Because most likely it's going to go down, and that's exactly what we're seeing happening right now.
Well, you get this false sense of confidence when you get returns and you win and you win and you win, and you start to think like, hey, I'm never going to lose.
Right.
And then we have all these people doing it themselves, and they're not professional planners, they're not financial advisors.
Right.
And most of them leave their wives in the dark. You experience it a lot, right? When the husband comes in and he's got the plan, and you know, he's going to take care of everything because he's the man, right?
Right. Well, a lot of people were very overconfident. You meet a lot of people that, you know, were investing in a lot of cryptocurrency, a lot of individual stocks. They were making a lot of money in tech. I remember meeting a guy a couple years ago that had quite a couple $1 million saved. And he was making a lot of money in the stock positions that he was in. And I told him, I said, look, I think with you being about 3 years out from retirement, the best thing we could do is protect some of this money and set up a pension for you for the rest of your life that would increase over time. So as cost of living went up, we would have enough cash flow coming in. He said, Brian, why would I want to take my money out of the market right now? I'm making so much money. I said, that's the exact reason why you want to take the money out of the market, because you are making money. If you made money for the last 12 years, and he said, I just can't see doing it. Now, he just called me again, and his portfolio has been cut almost by 40%. By 40%.
It's not a win until you take it off the top, right?
I've always said, Rob, if you've won the game, why keep playing it?
Because you're getting bad advice is why you keep playing it. So you've been a financial advisor for 22 years.
Yeah.
What most people don't know is my background. I'm a consultant, and I work with financial advisors all over the country.
Yep.
And I get it. I've got a pretty good view of what's going on in the world. And it's funny. There's so many people out there, and I can say this, you can't, because you're the bad guy if you say it.
Right.
But there's so many people that are willing to put their own financial success behind their relationship with their financial advisor, meaning they're more worried about upsetting their financial advisor and doing what's right for them.
Yeah.
Than they are upset. It's insane.
Breaking relationships. It's very hard for people to break relationships.
In a time like this,
Yeah.
it's dire. You have to get a second opinion.
Yeah.
We haven't even talked about the legislative risk with the increasing amount of cash we've printed, right?
Well, Rob, I'll tell you, that is a big risk, but I'll tell you why a second opinion is so important, because typically the advice that people are going to get, okay, the traditional advice to get, and I know this because when I started in the business over 20 years ago, these are the cookie cutter things that I was taught to say at the financial firms. Don't worry about it, hang in there, it's just a paper loss, it'll come back.
Right.
These are just sound bites to manage emotions. These are not
Everybody's
real strategies. They're not real strategies.
Right. That's not a plan.
That's
Hold on is not a plan.
Hold on is not a plan. And this is why I really would like to see people take advantage of our Right Track Retirement Review, because we really lay a lot of this stuff out for people where we can show them how to maximize their income. We can show them how to reduce taxes. We can show them the proper investment mix to have so that if the markets do continue to be volatile, that they don't have to be walking around on eggshells wondering whether or not their plan's going to work.
What's happening right now is scary. Each one of those challenges by themselves can derail a retirement plan. We have all four working in unison together right now against us. They're not working for us, they're working against us. We always give people ways to fix stuff on their own. This is not something a person can fix on their own. This is not something a do-it-yourselfer can do on their own. Hey, I think we're out of time here. I think we're going to commercial break, and I think you have something for the audience.
Let me just tell you, take advantage of the Right Track Retirement Review. It's really going to help you with 5 key areas: income, taxes, investments, healthcare, and legacy planning. We'll show you how to maximize your retirement. We'll show you how to get through these volatile market times. We'll show you some better approaches that you might not even be aware of. All you got to do is call 888-382-1298 or scan the QR code at the bottom, and you can schedule an appointment with us.